Hello, I'm Henry Becker, Director of Research with Lighthouse Wealth Management. And in this brief video, I'm going to talk about a topic that we've covered a few videos back, which is volatility. If you hadn't noticed, in the U.S. equity markets, volatility has returned. But let's put this in a framework that might make a little more sense for people in terms of understanding the pickup in volatility. So if we look at the S&P 500, the broad stock market index for the United States, if we look at that index year to date for 2018 through November 9th, we've seen 48 days where the market was either up by 1% or more or down by 1% or more. And 1% moves considered a fairly sizable move. Now, to put that in context, in 2017, we had 9 total days where the market moved by 1% or more or moved down by 1% or more. In 2016, we had 48. And in 2015, we had 73. And I could keep going back and back, and I think you're getting the point, which is 2017 was a very odd year in terms of low volatility. It was almost like the market went to sleep. But what we're going to do is take a look at another resource that I came across recently that I thought was invaluable in terms of understanding the intra-year movements of the stock market. So in this little chart from the American funds, it shows the S&P 500 going back to 1948, and it shows you the intra-year movements as well as the end result of the S&P in these bars. So very quickly, the bars, the dark blue is the return for the year. The light blue is how far up the market got in that year, intra-year. So for example, if we take this year right here, which is, we'll say, about 1955 or 56, we see the market was up about 25%, but it actually got as high as 32, 33%. And then we have the same on the bottom, where the dark gray is where the market ended in that year, and the light gray is how far down the market did reach. So the one thing I thought was, and I'd never noticed before, I've been at this for a long time, is that each of the years in the S&P where the S&P was down, and I'm rolling my little cursor hand to each one of those years, you take note of the fact that the market went further down than where it really ended. So right here, there's gray space. That means the market was down. This is about 1977. The market was down almost, we'll call it like 38, 39%, but ended at down 30. This year, same thing. It was way further down, but ended not quite as bad, not quite as bad, not quite as bad. So that was something I'd never noticed in the numbers before, but when you put this picture up, it makes it a lot more understandable. When we talk about volatility, volatility is if we drew a line to the peaks of each of these and then where the market settles in. You see, it's the market settles in less than what the actual volatility is, or the swings in the market, that is. And then this lastly, this little box here outlines the number of declines from 1948 through 2017. We had 182 declines of 5% or more, 56 of 10% or more, and you obviously you can read, you can see. But when you look at it on an average, 20% or more, 11 times every 6.3 years, we haven't had a 20% decline or more in quite a few years now. So, not that we're ever looking for them, but I'm sure that's on the horizon at some point, because it's part of the market. It's a way of the market adjusting and cleansing for overinvestment and those types of things. But I just wanted to share this chart because I thought it was very interesting and very telling about volatility in the equity markets. So for the most part, equity market volatility is driven by a small number of things, really. One, economic cycles. Economic cycles, some might debate it, but at least here at Lighthouse, we believe that economic cycles are driven by the Federal Reserve. As they loosen and tighten credit, you can put a ruler to it. The expansions and contractions in the economy come along with the expansion and contraction of the money supply and credit markets. Corporate earnings is another driver of volatility in equity markets. Government regulation, or even the threat of. And then lastly, geopolitics. And what's funny is, if you think about it right now, we have all four of those factors at work. Now, you could make the argument that that's always the case, and you could probably be correct. You could pull a newspaper from a library from any year in the last 100 years and probably pick out one, if not many, of those items on days where the stock market was, booming or busting. But the reality is, we're dealing with all four of those factors right now. Corporate earnings, some are really powering ahead in earnings, and some are starting to slow down significantly, especially overseas. Economic cycle, we are in a tightening environment. The Fed has been raising interest rates after being at zero for a long time. Government regulation, especially in technology, we're definitely seeing the rumblings of that beginning. And then geopolitics, I don't even think I need to speak about that, but if anybody's been paying attention to the news, geopolitics is a big thing right now. So suffice it to say that volatility is here. It's back, and it's probably going to be here for a while because of all the factors I've just pointed out. So, as we go forward, if you have questions, issues, concerns, please feel free to reach out to us. We're always happy to walk you through our thoughts or ideas with the markets.